Ben, great to see you. How are you? You've been in Switzerland, so you've had a kind of busy.
This morning, yes.
Yeah. And you've given a lecture already.
1 o'clock.
1 o'clock.
Right. Can't keep me beyond that.
Thanks very much.
Can you look at these, please, sir?
All the British economy, Mr. Bernanke.
Well, good afternoon, ladies and gentlemen. Welcome to the LSE. But he's not going to play that this afternoon. Chairman Bernanke, thank you.
For almost a year and a half, the global financial system has been under extraordinary stress. Stress that is now decisively spilled over into the global economy more broadly. The proximate cause of the crisis was the turn of the housing cycle in the United States and the associated rise in delinquencies on subprime mortgages, which imposed substantial losses on many financial institutions and shook investor confidence in credit markets. However, although the subprime debacle triggered the crisis, the developments in the U.S. mortgage market were only one aspect of a much larger and more encompassing credit boom whose impact transcended the mortgage market to affect many other forms of credit. Banks are choosing to leave the great bulk of their excess reserves idle, in most cases on deposit with the Fed. Consequently, the rates of growth of broader money aggregates like M1 and M2 have been much lower than that of the money base. At this point, with global economic activity weak and commodity prices at low levels, we see little risk of inflation in the near term. Indeed, we expect inflation to continue to moderate. However, at some point, when credit markets and the economy have begun to recover, the Federal Reserve will have to unwind its various lending programs. To some extent, this unwinding will happen automatically, as improvements in credit markets should reduce the need to use Fed facilities. Indeed, where possible, we have tried to set lending rates and margins at levels that are likely to be increasingly unattractive to borrowers as financial conditions normalize. Fiscal policy can stimulate economic activity, but a sustained recovery will also require a comprehensive plan to stabilize the financial system and to restore normal flows of credit. Despite the understandable focus on the near term, we do not have the luxury of postponing work on the longer-term issues. High on the list, in light of recent events, are strengthening regulatory oversight and improving the capacity of both the private sector and regulators to detect and manage risk. And finally, a clear lesson of the recent period is that the world is too interconnected for nations to go it alone in their economic, financial, and regulatory policies. International cooperation is thus essential if we are to address the crisis successfully and provide the basis for a healthy, sustained recovery. Thank you for your attention.